Well, hello, everyone. I'd like to welcome you back here to our next series in the Spring 2021 webinar series for Tennessee Master Beef Producer Program. I'm glad that you could be back here with us today or this evening and enjoy another round of educational information that you can use to hopefully take back and improve your situation there on your cow-calf operation, stocker operation, or feeder cattle as well. So I think tonight is really neat from the aspect that it applies to each of those situations more so than sometimes the things we talk about apply more directly to cow calf production. I think there's something in here for anyone and everyone that's in any phase of the production component of beef cattle in the southeastern U.S. A couple of things before we jump in and I introduce the speakers. Just want to remind you that this webinar series, as well as this past fall webinar series, we partnered with the U.S. Roundtable for Sustainable Beef to deliver to you. More specifically than that, even though we are, UTI is a member of the U.S. Roundtable for Sustainable Beef, within that we've networked with some other partners in that, and Golden State Foods and Nestle, both kind enough to help support this webinar series. And as we do that, some of the reason we partnered on it is one, to test some of the metrics that the roundtable uses to measure and try to improve our sustainability. Also, to give Tennessee producers a voice in the sustainability discussion, so that the things that we already do that are sustainable are recognized, and that our continued striving to improve on that sustainability is also recognized. And then the other thing too is, as the market moves toward rewarding us for sustainably produced beef, hopefully we have our Tennessee producers ready to accommodate that kind of market signal, and that give you a competitive advantage in marketing your cattle. A couple of other things, remind you that these are webinar formats on Zoom rather than meetings. So we don't see your video, we don't hear your audio. So there are a couple of ways that you can communicate with us tonight. One of those is through the Q&A box. So somewhere on your platform that you're viewing this on, you should see Q&A with a couple of little bubbles there. You can click that, type in a question. I'll be watching those questions as our speakers present this evening. And then toward the end, I'll ask those series of questions, as many as we can get to, so that you'll have a way to if you had some questions tonight to ask about risk protection, you can enter those in and ask our speakers to address those questions. The other thing, you can also type in the chat if you have maybe some kind of format or program type questions, need some assistance here on navigating this or answering the survey, something like that. That might be better to put in the chat box. But we'll be watching both of those, so I'm glad for you to use either one. I'll also remind you too that throughout the webinar this evening, we'll have a couple of questions, and you'll be able to interact by answering those questions. So Courtney will bring those up, and assuming that you're on the Zoom desktop app, you'll be able to click and answer those. I think you can answer those as well on the mobile app. But if you're watching in a browser, in a web browser, you may not see the question pop up, but that's okay. We're, for this spring series, rather than taking our attendance by the poll questions, we'll follow up with a survey directly after the webinar, and then an email follow-up tomorrow too, that you can reach that survey link through as well. And so you can put your answers in there if you're not able to interact on the screen. Also, before I introduce our speakers tonight, I want to remind you about the Mid-South Stocker Conference that's actually happening tomorrow. I put a link for the Mid-South Stocker Conference in the chat box, and I'm going to put a registration link, and it should show up for all of you watching. If you just saw a link pop up in your chat box, you can click that link and register for the Mid-South Stocker Conference that will happen tomorrow. Usually that's a full day conference, but we've condensed that down to between 12:30 and 2:30 Eastern time. So between 11:30 and 1:30 Central time tomorrow, you'll be able to take in the Mid-South Stocker Conference. We'll have two speakers on that. Again, realizing everybody's probably had their fill of Zoom for a while. We didn't want to make a full day of Zoom, but we did want to continue delivering the Mid-South Stocker Conference, and we're doing it in that kind of virtual condensed version that you'll be able to take in tomorrow. And you can click that link in your chat to register directly for that. All right. So our speakers tonight, we're going to be discussing price risk management. And more specifically, I've asked Josh and James to talk about, how you'd use it and just some of the ins and outs of it. Josh Maples is an extension specialist from Mississippi State University. Josh is actually from just a little bit across the Tennessee-Alabama border from where I sit. It's where he grew up on in cow-calf production. I've known Josh for several years now and have done meetings with him in different places in Mississippi, and here we've had him speak here in Tennessee. So I'm really excited to hear Josh talk about risk management. And also another one of our speakers tonight is James Mitchell, who's assistant professor in Ag Econ at the University of Arkansas. One of the neat things I noticed about James, he and I haven't met in person yet, and tonight's the first time before we started the webinar that we've had an opportunity to chat, but he has an undergraduate degree in animal science, so something you don't always see, moving from animal science into Ag Econ for his graduate degrees, his MS and PhD at Oklahoma State and Kansas State, respectively. So both these guys, even though I don't know James, I'm quite certain by the references that he carries with him, excellent economist. And like I say, I've known Josh for several years now, and I know he's a really good economist and a great teacher. So looking forward to hearing them tonight discuss price risk management. So with that, guys, I'm going to turn it over to you and let you take it from there. I'll stop my share. All right.
Well, thanks, Justin. Can you hear me okay?
Yes, sure can.
All right, let me get my screen share going here, and I'll get us started. Justin, can you see that all right?
Yes, looks good.
All right. Well, first off, thanks for the invitation. Wish we were in person doing this, just like all of these things, but we're certainly excited to be able to join you virtually. It's a good setup, Justin, because you've got somebody from Mississippi and somebody from Arkansas talking to a group of folks in Tennessee, and we never actually left our towns that we're in. So I'm at least excited about this from that perspective, and I do look forward to getting back to Tennessee sometime to do some meetings with you. So we're going to talk about price risk management. This is what Justin asked us to talk about. We're going to dig into what is price risk management for cattle producers and some ways that you can use it. So I'm going to start out just a little bit about, why should we do price risk management? But I'm also going to dig in on some reasons that we don't always do price risk management. And James and I are not here to push particular things on you. There are some situations where the tools we're talking about tonight might not fit a particular operation. So we'll talk about that a little bit. We're going to jump into a brief market, kind of situation outlook style talk. James is going to do this. And, this is important when you start talking about price risk management. That's really when thinking about what's going on in the market and looking ahead becomes important, because you're going to have the ability with some of these tools to make decisions, future decisions about what you're going to do in the future. And so having an idea, or at least building some expectations around not only where the current market is, but around where you think it's going to go is going to be an important piece to any price risk management decision. We're going to go through the tools, and the most common tools are the ones we're going to cover tonight, thinking futures contracts. So how can you use the futures market to manage your price risk? How can you use options? So options on futures contracts. So I'm going to introduce these topics, introduce what the tools are, and go through how you could potentially use them for your operation. And then the last one we're going to cover is livestock risk protection. You've probably heard of this as LRP. So James is going to walk us through how LRP works, including some pretty big changes, Justin, that we've seen just in the last 18 months on how that program is designed, and quite frankly has made it more beneficial. and then we'll wrap up. So we're going to work through each of these, talk through some examples on how to use them, and then of course have plenty of time for questions and answers at the end. So the very first one, and this is paramount for the whole discussion, is, why should we do price risk management? And I'm going to summarize that with the word of 2020. So the key word from last year was uncertainty. We heard it more than we probably had the rest of our lives combined last year. So this is the 2020 May feeder cattle futures contract. And if you don't get exactly what's going on here, I'm going to dig in a little bit later as to what the specifics are. But you can think about this as an expectation of what feeder cattle prices are going to be in May of 2020. So the dates here are basically looking at end of 2019 through May of 2020. So this is a year ago now. And you'll see, and I don't know if you can see my clicker here, but you'll see that, really from November through about February last year, that May feeder cattle contract was trading somewhere around $145 to $150 per hundred. Then, of course, we had the big disruptions, right? And we saw a pretty big drop in February. That was kind of the first sign. And then really when we went into full lockdown mode and as we got towards March, we shaved about, at the lowest point, about $35 per hundred off of what we thought feeder cattle in May were going to be worth in a matter of weeks. And so, this was the uncertain times, right? We didn't know what was going to happen, and that uncertainty really bared out what our market prices did. It wasn't just feeder cattle prices, it was also, or not just futures prices, I should say, also prices at our local markets were impacted. So, that's really I hope is the most extreme example of why we should do price risk management. I certainly don't hope that we have any more cases like that where we have the disruptions that we saw last year. But that's kind of just the other price swings do happen. Price swings in any year happen for a variety of different reasons. So preparing for that, those uncertain swings is important. Mitigating the impact of price declines. So we know price declines are going to happen in general. Prices aren't always going to go up. So we can use price risk management tools as a way to mitigate the impact of those price declines. Another one, and Justin, you alluded to this in your intro, taking advantage of a strong market. As cattle producers, we generally are selling cattle once a year, right? We're unless if you're a stocker operator or something like that, and you're constantly in and out or buying and selling, that's a different story. But if you're a cow calf producer, you're going to sell those calves or maybe once a year. But how do you take advantage of, let's say, if the market is stronger at a certain time of year than the other? These tools are going to use to potentially take advantage of what you think is a strong market, even if you don't have anything to sell at that time. So maybe trying to lock in something whenever prices are stronger and not just be subject to what prices are at the exact time you generally sell. And then finally is to be able to help plan your revenues. And I say or cost here. It's possible to do some price risk management on your inputs. We generally see that maybe at like the feedlot level whenever they're buying a lot of bulk commodities like corn. They'll do some price risk management to manage what their input costs are. It's not as big of a thing for most of our producers here in the Southeast, unless you're pretty big and you're buying a whole lot of inputs. So I want to touch just briefly on some examples of why not to do price risk management. These are things that I've heard while doing meetings throughout Mississippi, across the Southeast. The reality is a lot of people don't do any kind of price risk management, and it's not because they're irrational. It's not because they're clearly missing something. Sometimes there are true reasons, good reasons to not do it. The first one, and this is my favorite one, and there's always somebody in the crowd somewhere, wherever I do a talk, that is always bullish on prices. The glass is always half full, ever optimistic that prices are going up. And so if you're always bullish on prices and you think prices are always going to get better and better and better, price risk management is preparing for those downturns, right? It's preparing for mitigating the impact of price declines. So if you're that one person in the crowd and you truly believe prices are always going up, then it might not be a good fit. But realistically, the more common ones are just too complicated. And James and I hope we can help with that a little bit here and point you towards some tools that might help and explain some of them. Another one is too expensive. A couple of the tools we're going to talk about do require you to pay a premium. Think about it as an insurance kind of premium. Those things cost money, and rational producers can decide that they're not willing to pay that level in order to offset their price risk. So that is a real reason that you might not want to do it. But that's going to depend on your risk preferences, and I'll touch on that in just a second. Next one, lack of good tools for your operation. Some of these tools we talk about is going to require a certain number of pounds or a certain number of maybe head, if you think about it in terms of how much your cattle weigh. So some of these tools aren't going to fit every operation. So a futures contract, for instance, you got to have quite a few cattle or quite a few pounds to really do a true hedge with futures. So it might not be a good fit for some smaller operations. LRP might be a better fit there. But then the last one, it's all about your risk preferences. And that's another thing, that I think we really got out of 2020 is, we all have very different risk preferences, right? And what your risk preferences are, how much risk you're willing to absorb, is going to determine whether you should use some of these tools. And it's going to determine to which level you should use some of these tools. You might be somebody who just really is okay with accepting more price risk. We may have, there are certainly people out there that are, go on the other end of the spectrum. Maybe they're willing to pay more to get rid of price risk just because they don't want to absorb that price risk. So what your risk preferences are going to be key to this to this discussion, or to this decision that you're making anyway. So with that, I'm kind of set us up here. I'm going to kick it over to James to lead us through a little bit of a market situation and outlook. James, I think you're muted.
Yeah, thanks for kicking it off, Josh. So I'm going to do some market outlook for us, kind of prime us for the rest of tonight's discussion. We're not going to do a full swing of everything that's happening in terms of situation outlook, just kind of do a big picture overview of where we are with an eye toward the future. As we're talking about risk management, price risk management, all the tools that we're going to review tonight, I think kind of having a general understanding of where we are is certainly a useful first step for all of us. So I thought we'd start with a big picture kind of supply and demand situation outlook. So Josh and I are economists. So day one, with everything that happens with cattle markets, kind of processing it in terms of, is this a supply change, a demand change? So kind of starting us off there. This graph we've got in front of you is federally inspected beef production weekly, so million pounds on the vertical axis, and then in this table on the right, we've got forecasts for quarterly beef production for 2021. So, kind of starting out the year, we were producing above where we were in 2020. A lot of this is carryover from where we were at the end of 2020, working through all those COVID-19 supply disruptions. So inventories were high, cattle weights were high, producing a lot of beef here in the U.S. This recent decline that's quite noticeable that you see, this is very much reflective of kind of the hot topic, kind of what we've all been dealing with the past few weeks, which is weather. So a few weeks ago, we had 2 large plants that had to shut down for scheduled maintenance. Past few weeks, we've been certainly fighting weather conditions. So processors have probably slowed down processing speed, processing how much they're producing. So that's what's really resulted in the decline that we've seen as of recent, expecting to see that pick back up a few days to a week's time. When we look at production for the remainder of the year, we're forecasted to be down 1.2% on the year. this is really just coming off of fewer cattle, as well as dressed weights hopefully moderating, right? So one of the byproducts of what happened last year, of that bottleneck that we've all become quite familiar with, was the huge increase we saw in dressed weights, right? So for example, steer dressed weights were averaging 28 pounds higher than they were in 2019. So as dressed weights moderate, as cattle numbers decline, which we're expecting this year, we're expecting to see production down 1.2%. Demand side, so we've got percent change in monthly retail and food service sales for 2020 and 2021 versus 2019. So on the vertical axis here, this is the percent change in sales in 2020 and 2021 compared to 2019, right? So as we kind of ended out the year, grocery store sales still remain elevated above 2019. COVID-19 certainly picked back up kind of the latter half of 2020. A lot of those stay-at-home orders were put back in place. Food service remains below where we were 2019. What does all this mean? So the bright spot of 2021 that we're all monitoring closely, and what that means for beef demand, is the wide-scale rollout of the COVID-19 vaccine. So the hopeful idea is that as more and more of the U.S. population is vaccinated, potentially we'll see consumers returning to pre-COVID eating habits. So consuming more meals away from home, which is certainly a positive for beef, right? If we learned anything from 2020, was despite high retail prices, beef demand remained relatively strong. Per capita consumption last year was actually above 2019. Of course, within that story, there was substitution away from beef products that you would probably consume in a restaurant setting versus what you're going to be consuming at home, cooking for yourself. So what does that mean for the year, for 2021? Again, these are LMIC forecasts, Livestock Marketing Information Center. It's a group that Josh and I are closely affiliated with and work with closely on a lot of these issues. They've got per capita consumption forecasted down 3.1%. Now, there's a caveat to this. This does not exactly mean that beef demand is going to be down in 2021. This is really a matter of accounting. So recall from the previous slide, production's expected to be down, so you can't consume more if you have less, right? So that's primarily what's going on here with forecasts for 2021. Thinking through market, so I've got here prices for 500 and 600 pound steers for medium and large ones and twos for Tennessee. Currently still below where we were 2020. I think last week closed out for Tennessee $1.39 a pound. Again, the big part of this was limited market activity because of the storms that we were impacted with across the country, right? So looking at the data just a few moments ago for Tennessee, for example, only 412 head in the entire state were sold last week because of how much this storm impacted everyone, right? So generally, what does that mean? Well, that means if you've got less cattle selling in the state, you would conceptually think, okay, well, that's less supply. Well, this also impacted demand for cattle, right? No one was wanting to get out on the roads and take cattle home. Feedlots were impacted by this just as much as everyone else was, right? Cattle performed poorly in cold weather. They certainly had to adjust rations in certain parts of the country as well. And so that was a driver behind what we're seeing last week as well. Looking towards the future for what we expect to see the rest of the year, fourth quarter of 2021, we are expecting prices to be above where they were this time or fall of 2020. To what extent are we actually going to see prices higher than where we were in 2020 is very much going to depend on what the corn situation looks like. So what the new crop comes in at, what it's looking like planting wise here in a few months. That's going to be a main driver behind what we observe the latter half of 2021, especially for our lighter weight calf prices, right? So you've got more expensive corn. It's more costly to add pounds in the feedlot. So potentially feedlots are going to be favoring heavier cattle that have more pounds put on outside of feedlots. And again, thinking through kind of what those storm impacts were, right? So this was both a market consideration as well as a production consideration. So I like this this table here that shows us the percent of the U.S. Calf crop that's born each month, and so we haven't quite gotten into the full swing of the spring calving, but certainly a lot of people were impacted at home because of what happened last week. I like to look at slaughter cow prices as well, right? So generally, cull cows will generate between 15 to 30% of total income for our cow-calf producers. 2020 slaughter cow markets were if anything, the bright spot of what happened, right? So cull cow values are driven by ground beef demand, the market for ground beef. That certainly held in 2020, which was why we saw prices that were averaging pretty high, relatively speaking. 2020, we're seeing more of that 2021. So the thing to look for as we move through this year and we're thinking about cull cow markets is looking at what's cow slaughter doing, beef cow slaughter, and then what is dairy cow slaughter doing as well. So despite all the disruptions we saw last year, a lot of the USDA programs, the programs that supported our dairy producers, potentially held dairy slaughter above what we might have expected. Less dairy slaughter means more demand for beef cows to use for ground beef production. So monitoring both beef cow slaughter, dairy cow slaughter will be important to see what ends up happening the remainder of 2021 for cow markets. Again, driven by beef cow slaughter. So what do we have here? We've got weekly federally inspected slaughter in the U.S. Cull cows are a much more regional market compared to feeder cattle markets, perhaps. So this is national slaughter. There's definitely going to be variation in this regionally, but nationally, prices are averaging 2% above 2020, or slaughter, excuse me, is averaging 2% above 2020 and is averaging 30% above the 2016 to 2019 average. So with higher slaughter, the only reason or only way you get higher cull cow prices is with demand remaining elevated for ground beef. So that tells me that ground beef demand is there and it's supporting our cull cow markets. So that's kind of, the only other thing, the main thing that's on everyone's mind. So one is corn prices. That's the main talking point that we've all been focusing on this year. And point two is pasture conditions. So for reference, this was pasture conditions December 31st of 2019 for comparison. This is where we were last week. So yes, that storm certainly impacted a significant part of the U.S. But if you see here, the Western U.S. is still significantly impacted by drought. What does all this mean? So coming into the year, hay stocks were slightly down in the U.S. Definitely a regional thing. So hay stocks were down significantly in the western parts of the U.S. In my state, Arkansas, they were down 10%. Tennessee was actually up 1%, I think. So together, if drought persists, we could see cow slaughter pick up significantly if drought forces producers to make marketing decisions counter to what they would do normally absent drought. So bringing all this together, what does it all mean? So the cattle inventory report came out in January and it put total inventory down 0.2%. And we've also got here on this bar graph, we've got cow-calf returns for 2020 all the way back to 1992 with a forecast for 2021. So last year, cow-calf returns were down at $58.26 per cow. Importantly, this does not include CFAP payments that producers might have received after applying for this. Forecast for 2021 is to see cow-calf returns around $27.32 per cow. This has actually been revised downward on higher feed costs. So what does all this mean? This tells me that, yes, we're going to see positive returns in 2021 and potentially also in 2022, but probably not enough to kind of kick us out of liquidation and into an expansionary phase for the cattle cycle for inventory numbers. And when we look at what's driving returns, there's markets, and then there's also our costs. So as we go through the rest of the night, kind of the number that we want everyone to be thinking about is what's your break-even cost of production. That kind of gives you an idea of price-wise what you need to break even. So in this example, 2021 cash costs are expected to be $831.42 per cow for the year. So if that's your cost of production, and you're planning to sell 650-pound steers this fall, for example, divide this number by weight, and you get a break-even price of $127.91. You can adjust this if you account for non-cash costs, and then you can also adjust this number if you were to account for, revenue from coal cows, accounting for 15% of costs. So this number in the back of your mind, kind of carry this through the rest of the presentation. And with that, I'll kick it back over to Josh to kind of give us a discussion of price risk management, and then continue on with futures and options.
Get going here again. Hopefully this works, but if y'all can't hear me or can't see it, please let me know. But
Looking good, Josh.
thanks, Justin. So thanks, James. Thanks for kind of giving us the setting for what's going on in the market and maybe looking ahead a little bit. I think that break-even price is really important. I've worked with quite a few producers, and Justin, I know you probably have too, James, on that break-even price varies widely depending on what production practices are. So it's really important to at least get some sort of gauge for your operation, because those cow costs are going to heavily depend on what you do on your operation and what I do on my operation. So it's important to get a feeling for what those are. So let's, Courtney, this is our first poll question here. I'll toss it to you real quick.
Yeah, give me just a second. Okay, you should see question 1 now popped up on your screen. Question is, which of these risk management tools have you ever used? And then you can choose all that apply. So on this one, you can choose more than one. So either a forward contract, futures contracts, options on futures, or LRP, the livestock risk protection.
Thanks,
I'll give a few seconds to answer that one.
Hey,
Okay.
Josh, while they're answering that, just curious what you usually see, maybe even just a ballpark percentage of cow-calf producers maybe that have used some sort of risk protection in their marketing versus stocker operators.
Yeah, I mean, I don't have a great percentage for you, Justin, but certainly stocker operators are more likely to use this because they're buying and selling frequently. I would say on cow-calf operators, it's a pretty small percentage on folks who actually use this, and a lot of the reason why we'll talk about going through here. Some of these things just don't fit cow-calf production, to be honest with you.
Yeah.
But there's been some changes to LRP, and I think LRP is going to get closer to being something that fits.
Okay, I'm going to end and share the results with you.
Well, this is great. So we've got 26% have used about 26, call it 25% have used either forward contract, futures contracts, or options, and 43% you have used LRP at some point. So that's fantastic. Glad to see that. So thanks for doing that, Courtney. So these are the choices we're going to discuss for price risk management tonight, and we're going to take some time to dig in on each of them a little bit. So I'm going to start with futures contract and then comparing it back to a forward contract. Then I'll go into a little bit of options on futures. The thing I'll say about these first 3 bullet points, I teach an entire class in the spring to our seniors here at Mississippi State called Commodity Futures and Options. So this is a big topic, a lot going on, certainly not something that we're going to be able to cover as in depth as we'd like to in our time tonight. So I'm going to try to kind of ease into the basics a little bit. So the first one is just, what is a futures contract? And I'm going to compare this back to maybe what we think about as a forward contract. So a futures contract is an obligation to buy or sell a commodity, but it has specific features that are determined or that are set by the exchange. So if we think about maybe a forward contract would be, I call up Courtney and say, Courtney, I'm going to sell you, 10 head of 700-pound steers in, August or something like that. And then you and I come to an agreement about what those are, what the quantity is, where we're going to, where's the location, the date, all that kind of stuff, we could work that out. A futures contract, all of those specifics are set by the exchange. And so the exchange gives us, sells us what the quantity is. So for our feeder cattle futures contract, you're talking 50,000 pounds. Quality. So, what are the quality, exactly what is getting traded. The location, feeder cattle futures contracts are cash settled. So it's not a deliverable contract, but there are locations associated with what that cash settlement price is. And we'll talk about that in a minute too. And then also the date. So when does the contract expire? And all of this is going to happen at a price that a buyer and seller come together on. So, if we're trading a futures contract, we can buy or sell it today. And the only thing that we're really setting is the price. When buyers and sellers come together, they determine what the price is going to be because all these other things are set. So some advantages to futures contracts versus forward contracts. Futures contracts, this standardized feature of futures contracts allows it to be something that everybody knows what we're trading. So regardless of where we are in the country, if we talk about a feeder cattle futures contract, we all know the specifics of that. We can look it up on the CME website and see exactly what it is that we're trading. We're not mixed up on what the quantity or quality or anything like that is. And the second biggest piece, and I'll talk a little bit more about this in a minute, is that performance is guaranteed. So the exchange, CME group, the exchange kind of acts as that middleman for every single contract. So if you buy a contract or if you sell a contract, the performance of that contract is guaranteed. And we'll talk about how that process works. You compare that to a forward contract. The forward contract is guaranteed as long as both parties uphold their end of the deal, right? And I know that happens most of the time, but there's the futures contract is structured so that it won't fail. We'll talk about margin accounts. So every buyer or seller of a futures contract has to have a margin account, and that margin account is what's used to guarantee payment one way or the other. So futures contracts, a lot of times they get kind of confused as being this separate thing from maybe our local auctions that we think about, but they're really, contract is derived from, think about the cash price. So it's really derived from, going back to those points James was talking about, the supply and demand of cattle. So if the value of cattle overall goes up, we expect the futures contract to reflect that. If we get in a supply and demand imbalance and cattle are worth less, we expect the futures contract to reflect that. And I'll talk about that connection a little bit more in a minute. So the benefits of trading futures, or futures trading. So futures contracts, they provide us with a handful of different things. The biggest one is they can be used as a risk shifting mechanism. And that's what we're going to talk about tonight. But the other thing is they're a price discovery for them. So back to that point where the contract specs are set, these things, futures markets, you can go and look and see what futures markets are trading at any day. And from that, you can develop an evaluation of what you think your cattle are worth. So even if you don't actually trade, you can use futures markets to get an estimate about what your cattle may be worth at some point in the future. So there can be used as a price discovery forum, a central reference point for prices, and then just an information forum as we get new information that comes in. So think about cattle on feed reports or the cattle inventory reports that just came out, or the weather from last week. Futures markets are a place where all of that information can enter the market and can be viewed by anybody who's looking. So how do those things impact prices? I'll just walk you through a couple of terms, and given how many of you have traded these, I'm guessing a lot of you know these. You'll hear people talk about being long. That just means they've bought a futures contract. So if you're long a feeder cattle futures contract, that means you bought one. If you're short, that means you sold one. And this is one of the key questions I get from students in class. How can you sell something before you buy it, right? Well, in futures, you're able to do that. So you can go sell a futures contract and then ultimately buy it back. And we'll talk about that, the mechanics of that a little bit more in a minute. Bullish, we talked about that earlier. Bullish just means a participant thinks prices are going to rise. Bearish thinks that prices are going to fall. And then offset. So offsetting a contract, and that, think about that as just canceling out your current position. So you just take an opposite position to what you previously had. So let's say you are currently long 5 November feeder cattle futures contracts. You can offset that position and get out of the market by selling 5 November feeder cattle futures contracts. And so that's how the mechanism works. You get in either long or short, and then to get back out, you do the opposite position at some point in the future, and you either capture the returns you made during the time, or you lost money during the time you did that. Feeder cattle are cash settled, and we'll talk about that relationship to the CME index in a minute. But they're settled against the CME feeder cattle index, and I'll talk about that again. I've got the detail on that here in a later slide. Participants in futures markets, not just cattle futures markets, but all futures markets. The ones that we're talking about as being a hedger. These are people who own a stake in the physical commodity. So if we're talking cattle, these are people who actually have cattle, and they're trying to use futures markets to hedge their risk, protect against price risk. The other side of that is speculators. And speculators, anytime prices go one way or the other, or if they're really volatile, speculators often are the target, right? They get blamed for it, and it's usually the blame is well earned. But we need speculators. Speculators without them, the market would not work. So a speculator is someone who has no position in the cash market. They're not raising cattle. They're not raising the physical commodity of whatever they're trading. But they use futures as an attempt to make money. And it looks like I left money off this slide, but they're using futures as an attempt to try to make a profit. They want to buy low, sell high, or they want to sell high and buy low, which is something you can do. Hedgers need speculators because it provides liquidity for the markets. If the market was full of only hedgers, people trying to get rid of their price risk, there wouldn't be anybody to trade with. If there wouldn't be enough people to trade with, I should say. So we need that speculator to provide the liquidity to these markets. So this is just an example of what you can look at. You can go to the CME website right now and look up feeder cattle futures quotes. And Courtney, if you'll put up that other poll, what I'm showing here are the different contract months that are traded. And so we've got another poll here about which month most closely lines up to when you typically sell your calves.
Okay, yeah, and you should see that now. Question 2, just which of the CME contract months is the closest when you typically sell your calves? I went back and added an NA option for those that don't use them.
Good.
Sorry,
Thanks.
that wasn't in the previous question.
Yeah, so you'll see we've got contract months. Most of them, we don't have contracts during the June and July, but there's a January, March, April. A lot of action happens around that May contract, especially with stocker growers, and then we've got some of the fall contracts as well. And so typically, if you're going to use futures to hedge some of your risk, you would want to trade the contract that's closest to when you actually intend to sell your cattle.
I'm about to end and share it with you in just a second. Okay.
Yeah, so it looks like we're maybe August and October, somewhere through there is probably the biggest one. Then we've got quite a few NAs. So, matching up your hedging decision, if you do this with the contract month, is one of the reasons that folks get a little mixed up about futures. Because remember, the date is set by the exchange. It's not you calling up somebody and saying, I'm going to bring them to you on this date. You're set with this exchange as far as what the futures market does. They only expire in these months. Here's a futures cattle price chart. So this is for the May 2021 contract. So going back to that price discovery and price information forum. So the thing that's being traded every day is what feeder cattle futures contract is going to be worth in May. So what's it going to be worth at expiration? And you'll see that that gives us a chance, even going back to October of last year, the market was building an expectation of what feeder cattle would be worth in May of this year. And so you'll see it's been pretty volatile, got down pretty low as we got to the middle of October, and tied to a lot of what's going on in the corn markets. And then we've recovered since then. But you can go look and get a gauge of what those cattle are going to be worth when you intend to sell based on what the futures contract near that date is trading for. I'm not going to go through all these, but these are those contract specs I talked about earlier. Whatever the futures contract is, you can go to the CME website or whatever the exchange is, and you can check out the contract specs. So for feeder cattle, it's 50,000 pounds. And you can see all of these when it's traded. You can go see how it's settled and things like that. So I want to kind of narrow down just a little bit here. So we've been kind of talking big picture, futures contract value. So if you think about 50,000 pounds, so let's say that we're looking at, going long. It should be 3 May 2021 feeder cattle contracts at $140 per hundredweight. So the value of any particular contract is just going to be the current price multiplied by that preset quantity. So for feeder cattle, it's 50,000 pounds or 500 hundredweights. So if we do 140 times 500, then the value of one single contract is $70,000. So if you've got 3 of them, if you're long 3 of them, then that's $210,000. Which are really big numbers, right? And more than anybody is probably ever planning on putting up to do any kind of price risk. But the key difference here is that you're trading on margin. You don't have to put up the entire value of the contract. If you want to buy a futures contract, a feeder cattle futures contract, you don't have to give somebody $70,000 today. Their margin is used and provides significant leverage. So for feeder cattle, you can open up a contract, either buying or selling. So you've got about $70,000 worth of exposure, but it only would cost you only have to put up about $3,000 to get that position started. And so as you can tell, significant leverage, and you can control a big amount of money using a relatively small amount of money. So you would have to do this. You'd have to put it in your margin account right off to open the position. So if we think about margin accounts and what they are, they're updated every single day. So every single day, and I'll show you a chart in just a second, the exchange is in charge of figuring out, who made money or who lost money that day. And so then money would move from your margin account to whoever you've traded with margin account. And this is called marked to market. So if price moves opposite of your position, you could receive a margin call. So let's say you've bought at 140 and then price drops to 137. So you're long, but price has gone down. So the value of your position has dropped. And if it drops enough to trigger what they call a margin call, then you could get a call from that exchange that says, hey, you've got to put more money in today. And if it drops over a long period of time, like that chart we showed earlier back in October when we had consecutive days of big drops, to stay in, you would have to put in more money every day until price started going back up. So this is the big negative for futures contracts in terms of cattle producers using it for risk management. The amount of money that you could theoretically have to put into your margin account is nearly unlimited. If price goes, think about 2020, right? Whenever you lost $35 per hundred in a couple of weeks, and you multiply that out by a contract that's 50,000 pounds, that was big amounts of money if you wanted to keep your position open. You would hope that would help you on the other side. So let's say that you've sold a futures contract and price keeps going up and up and up. Well, that's bad for you for your futures position, but hopefully it's going to be helpful to you whenever you actually go and sell your calves because the value of your calves have gone up. So margin cash flows when futures price increases. So if a price goes up, every day money is going to leave the short trader's margin account and it's going to find its way to the long trader's margin account. So at the end of every day, everybody's margin accounts are in sync to reflect what happened that day. This mechanism right here is what makes futures contracts guaranteed, because regardless of whenever that contract closes out, the money is already where it needs to be. So you don't have to count on somebody to send you, you don't have to count on the person you traded with to send you a check. The money is already there every day. And that's another thing to think about here. So futures markets are, they're often called a zero-sum market. So for every buyer, there's a seller. If you go buy a contract, somebody has sold that contract. If you go sell one, somebody's got to buy it. Otherwise, there's not a market. You can't buy anything from CME. They're just a facilitator of trades. So for every winner, every time somebody makes a lot of money in the futures market, that means somebody's lost a lot of money. That's a little bit different than you think about stock markets, where if we all go invest in a company and it does really well, we can all benefit, right? But with futures, if somebody's benefiting, then somebody is losing money. So let's talk about, that's kind of, the quick and dirty 10-minute version of what a futures contract is. Let's talk about how you can use that to manage risk. So we want to shift our price risk. So hedging is that term to, basically shift your risk, shift your price risk off on somebody else. So it allows producers to shift price risk to another market participant, and allows you to, lock in a price months before selling time. So if you're not planning on selling your calves until August or September or October, you can go look at what the futures contract is trading for right now, and on what it's expected to be months out into the future. And this is accomplished by taking opposing positions. So you would, if you're planning on selling cattle in the future, and you want to offset your price risk, you could go sell a futures contract. So you could sell a November 2021 futures contract. Your opposite position is that you have the calves. So you're growing the calves. So you're long calves in your pasture, and then you're going to be short cattle in the futures contract. So those market movements, regardless of what the market does, the idea is that if it goes up, then that's good for your calves in your pasture, even though it's bad for your futures position. So let's talk through a quick example here. I'm going to jump on to the next thing. So let's say Justin, we've got a cattle producer named Justin. He anticipates 50,000 pounds of calves by August. In March, he sells an August feeder cattle futures contract. Then whenever August comes around, he goes and sells his calves at his local auction barn on the cash market, and then he buys back one of his August feeder cattle contract. So you'll see that he never actually delivered anything to CME or to whoever bought his contract on CME. He just offset it. So you still do your typical cash market activity, but then you offset your futures. So it's not risk-free. You still got basis risk. There's still, the price you get at your cash market is not going to be the exact same as what futures are selling for. So you still got that difference called basis risk. But you've alleviated some of the big market swings. So if we think about the relationship, and you don't have to read all this, I pulled it straight from the CME's website. By design, cash and futures should move together. The correlation is usually pretty high. Because the futures contracts are settled with the CME feeder cattle index. And the CME feeder cattle index is 7 to 9 weight medium large frame steers, and 7 to 9 weight medium large 1 and 2 steers in a 12-state region. That 12-state region doesn't include Tennessee. It doesn't include Mississippi. It doesn't include Arkansas. But generally what happens with prices in those regions is also happening in our area as well. But you can see how there can be some difference between what's happening in those regions and the prices you're getting at your local auction. So wrapping up the futures part before I get into options, they're an important part of ag markets. They play a key role in price discovery, and they really provide an arena for information to be used and discovered. So I'm going to hop into options real quick. options, we could spend a lot of time talking about options, but I'm not going to do that. But options and futures markets are really intertwined. So what I want you to think about is an option is a tool to potentially get into the futures market. So think about, if the price goes to this level, I want to be able to get in at a lower price. And an option, you're basically paying somebody the ability to do that. So if you buy an option, you've got the right, but not the obligation to either buy or sell a futures contract. And I'm going to use some examples here because I think examples are the best way to kind of describe what an option does. There's two different kinds of options: a put option. Whoever owns a put option has the right to sell a futures contract. And whoever owns a call option has the right to buy a futures contract. So somebody has to buy and sell a put. There's a buyer and a seller on both sides. And basically, so if you buy a put option from somebody, that gives you the right to sell a contract at some point. If you decide, I want to sell that contract, whoever you bought the option from has to take the other side of your trade. So they're taking on the risk that you're going to exercise your option. Premium is what it costs. You're going to pay them money to be able to do that. And then the strike price is the price at which you could get into the market. So I'm going to use some examples here and just to kind of tie this together. So a put option, the most common, best example I like to use is it's similar to insurance. So you can pay a premium if a bad event happens. So if we're talking about car insurance, let's say you have an accident, you exercise your contract. So you call your agent, right? And you say, hey, I had an accident. This happened. You file a claim and you receive a payment. So let's tie that over to what a put option is. You pay a premium if price drops. So in this case, if you've bought a put option and a bad event happens, like a big price decline, which is bad for your cattle, then you can exercise your option. So you can capture the difference between the market value and that strike price. So you basically can get back the value that you were trying to establish. A call option is just the opposite of that. So the call option gives you the right to buy something. So, a good example of a call option I like to use is a coupon. So this is a Papa John's coupon. It tells you what the underlying product is. It's a large 2-topping pizza. Strike price, this is the price you can buy it at. And the expiration date, this was a really old screenshot here, but you got to do it before this expiration date. So if you go down to the Papa John's and they're selling pizzas for $8, you're just going to throw this coupon away, right? You're not going to use it. It's worthless to you. But if you go down to Papa John's and they're selling pizzas for $12, you're going to use the coupon. Exact same thing happens with a call option. If you've got the call option and the ability to buy, because you own that call option, it gives you the ability to buy a feeder cattle contract at 144. If feeder cattle are currently trading at 150, you're going to exercise your option and you're going to get in cheaper. If they're currently trading at 135, you're not going to exercise your option because that would actually cost you more. So there's separate contracts. Puts and calls are separate. For every put buyer, there's a put seller. For every call buyer, there's a call seller. There's two different sides to these, and this is separate from a typical futures contract. You can think about the premium or what it costs you to get an option as your risk transfer cost. So if you're buying a put option and you're wanting to hedge against prices going down with that put option, somebody is absorbing your risk. There's another trader out there who is saying, all right, I would accept this amount of money in order to absorb Josh's price risk. And so you're offloading your risk onto somebody else. In order to do that, you have to pay them a premium. No different than car insurance, right? You're paying your car insurance company to take on the risk that you're going to have an accident and have damages. So there's a lot of things that can affect premium levels. They change all the time. Time until expiration. So how long do we have that a bad event might potentially happen? And then just current market volatility. Anything that drives up volatility in markets are going to make it more expensive from an option premium standpoint. Last couple points here on options. So you can go to the CME website right now and look at options quotes for feeder cattle. You can see these are the different strike prices. So let's say you wanted to buy a put option with a strike price of 146 for the May 2021 contract. Today that traded for about $5.10 per hundredweight. So you'd have to pay $5 per hundred in order to purchase that put. I won't spend too much here. Basically, just when you should exercise. So, if you own a put option, if your strike price is higher than what the current futures price is, then you should exercise it. Because you can sell for higher than the current market value. Flip side of that is a call option. So, last couple points. So, an option gives you the right, but not the obligation. So, think back to that coupon. You don't have to use it. You can throw it away. If the option gets to the end of its life or to its expiration date and it's not worth anything, you don't have to use it. And the key thing here is that your amount of money that you can lose is set. So we talked about futures contracts. You could get margin calls every day. With an option, with a put option, the amount you can lose is set. You're not going to have to pay any more than what you paid for that premium. So these can be really good tools to manage your downside price risk. And it doesn't eliminate your upside risk like futures do. With futures, if price goes in a favorable position for you, you're not going to be able to capture that because you're locked in on a futures contract. Whereas an option allows some upside risk to still occur. The downside, of course, is you have to pay the premiums and you're never getting that money back. As I'm passing it off to James here, I'll stop sharing. So you're going to see a lot of similarities between LRP and what a put option is as James kind of walks through how you can use LRP.
Yeah, thanks, Josh, for that discussion there, futures and options. I'm going to kind of follow just a similar format for what Josh did. Talk kind of, what is LRP? What are some of the basics, terminology? And then I want to wrap up working through a specific example. So LRP it's a subsidized price risk management tool that's designed to provide protection against downside price risk, right? So it's establishing kind of a floor for selling prices. What it doesn't do is it's not going to guarantee or establish a cash price, and it's not designed to enhance profit. And it's an insurance product that works for fed cattle, feeder cattle, and swine. At one point, I think it was also offered for lambs. I'm not sure what the story is behind them discontinuing or suspending it for lambs. Maybe somebody else kind of knows more on background there. And basically what it is an LRP policy. Payouts for that policy are based off of changes to the CME feeder cattle index. It's the same index that futures are settled against. And it's a 7-day moving average index of feeder cattle prices for 12 states. And the policy or the indemnity payment that you would receive from an LRP policy is going to be determined by what that index does relative to the coverage that you're selecting. And
hey, James, are you in presentation mode? I'm sorry.
Good point. Let me see here. There we go. Thanks, Josh.
Yep.
So importantly, your indemnity payment that you'd get from an LRP policy, it's dependent on what that CME feeder cattle index does. It's not going to be depending on, what local cash prices do. So it's not going to depend on what prices in Tennessee are doing. I say that because Tennessee isn't a state that's included in that index, that CME index. So you're still exposed to, in a sense, basis risk, the difference between what cash prices are going to be doing in Tennessee and what the CME index is actually doing. But the basic idea is for a policy, we're looking at what we expect that CME index to do, and we're going to select a coverage based off of what that expected value of that CME index is. And I'll discuss in more detail what that is in a minute. Like I said, it's for fed cattle, feeder cattle, swine currently. We'll talk through, these are the specifics for LRP for feeder cattle. So, there's several, advantages, disadvantages to using LRP. One of the advantages that I like are you can protect against downside price risk for different types of cattle, right? So calves, steers, heifers, Brahman type cattle, dairy, and also unborn calves, right? So you can insure or buy an LRP policy for let's say part of your calf crop if it's not even born yet. There's specifics on how you do that, which again I'll discuss shortly. And basically what you do is if you're going to use LRP, you need to pick the coverage period, which is the endorsement length of that policy. This coverage period should closely follow when you expect to sell those cattle. So if we're sitting here today, February 22nd, and we're going to sell some 700-pound feeder steers in August, for example, we'd want to select a coverage period that reflects when we plan to sell those cattle. And we also need to select a policy where the end weight is going to reflect what those cattle weigh when that policy expires. And our coverage period, you select your coverage level. So let's say the expected value today of the CME feeder cattle index, let's say it's expecting to be $150 per hundredweight in August. That's just me making that up. Let's just say that. If you selected a coverage level of 100%, that would mean that the policy would pay out an indemnity if the CME index, the actual index on the day that policy expires, is below 150. That's if you selected 100% coverage. Let's say again today, we're looking at LRP and the expected ending value. So today, what we expect the CME index to end in August, let's say again, it's $150 per hundredweight. And let's say you select 90% coverage level. What that would mean is if the actual ending value of that index is below $135 per hundredweight, then you'd get an indemnity. And per policy, you're maxed out at 6,000 head per specific coverage. And then you're maxed at 1,200 head per year. But another advantage to this is the minimum is 1 head. So you can insure, 1, 2, 3, and, you can half your calf crop, your full calf crop. That could be 20 head, 70 head, 100 head. I think I saw in the Q&A, someone was asking when Josh was talking about futures contracts, what size farms was Josh talking about for using these futures contracts? Well, a benefit to LRP is you can insure 1 head if you want. So really any size farm can potentially use LRP as a price risk management alternative. Here's a few updates for the 2021 crop year. So Josh talked about in the introduction, there were several big changes to LRP, hopefully making it an alternative that a wider group of people could use to protect against downside price risk. And the first one was a change to the subsidy. So the price of an LRP policy is the premium, very much like Josh talked about with a put option. And these premiums are subsidized. So currently what they changed it to is the max subsidy for an LRP premium is 55%. So if the subsidy is 55%, then you would pay 45% of the premium for an LRP policy. Previously, the max was 35% subsidy, and way back it was just 13%. So they've steadily been increasing what the subsidy is. So that's a way of decreasing the cost for someone using an LRP policy. They've also increased the max head per endorsement as well as the max that you could annually insure using LRP. Previously, it was 3,000 head per endorsement and 6,000 head per person annually. And then next, what they changed was they changed when you're insuring livestock on a policy against price risk with LRP, this change means that you have to own those cattle up until 60 days before the specific LRP policy for that group of cattle ends. So if today we have an LRP policy that we purchased, a few months ago, and it's going to expire or end in April 20th-ish, then today would be when we could sell cattle after that 60-day period. You have to have ownership of those animals up to 60 days of when that policy would expire. Previously, it was 30 days. And the big addition is that you can insure unborn calves. So basically how this would work is these calves can be unborn as of the date that you would purchase an LRP policy. And the expectation is that those cattle would be born and their end weight, the weight that they would weigh at the time that policy would expire, would be less than 600 pounds. And then finally, the last major change that they made to LRP was that the premium, so the price that you would pay for that policy, the cost of that policy, it's now due at the end of the endorsement, at the end of the LRP contract. So here I said that, you know, those premium subsidies, those subsidies for those premiums, for those costs of using an LRP policy, those increased to a max of 55%. And those are going to be based and changed based off of what coverage level that you would select. So here I've got the different coverage levels that you can select for LRP that range from 70% to 100%. And previously, the max subsidy was 35% for a coverage level between 70 and 89.9%. And then as you would increase your coverage, the subsidy would decrease. And you can see that they've dramatically increased what that subsidy is. So if you increase that subsidy, that decreases the cost of purchasing an LRP policy. And so three kind of take homes from this is that you'll notice is as you increase your coverage level, it becomes more expensive. The subsidy decreases and it's going to cost more to have higher coverage, but a higher coverage level is more likely to pay out as well, right? So I use that example. Let's say today the expected ending value of the CME index in August is expected to be $150 per hundredweight. Well, if you select 100% coverage, the price is by definition going to decrease below 150 if you've got 100% coverage than it will if you've got 90% coverage with a price of 135, right? So it's more likely to pay out with a higher coverage level, but it's also going to be more expensive. And then also an LRP, it's going to be more expensive the longer out your endorsement is. So today, if we picked like a 13-week endorsement, that's going to be cheaper than a 26-week endorsement. So the length of endorsements, those matter when you're selecting which LRP to use. Again, they should reflect when you're planning on selling those cattle. So a few advantages to LRP. So smaller numbers can be hedged. It's more available than options, right? So those endorsement periods range from 13 to 52 weeks, and they are in four-week increments. So 13 weeks, a 17-week, etc. Options, futures, and options, there's not a contract for each month of the year. So there's more availability in terms of what you can use for price risk management under LRP. And then finally, those subsidies are such that it might actually be a cheaper option than an option because those costs are subsidized. And then as Josh discussed, futures and options, you can teach an entire class on that. This is a little bit more straightforward, so potentially that is a benefit of it. Some disadvantages are you are maxed out at 12,000 head. It's not as flexible as futures and options in that when you look up these coverage levels and these rates and endorsements, not every coverage level and endorsement length is going to be available every single day. They are dependent on what's being traded on options that day. So after the board closes, CME sets the coverage levels and the rates that are going to be based off of what was traded that day. And so based off what's traded, not every option is going to be available every single day. And then again, you are still subject to basis risk, and you have to own the cattle up until 60 days of when that endorsement would end. So a few points to consider. So this says that the ending value, so what we expect the feeder cattle index to end at, is based off of an index, and it is driven by data. So to consider this is that index is going to move, prices are going to move locally. Those might not always move together. And then again, as I just discussed, not all coverage options are going to be available every day. And since coverage in those rates is based off of CME and it's based off of what was traded that day, purchasing those is actually going to run counter to when the CME board is open. So you can purchase an LRP agreement from 3:30, so a few hours ago, up until 9 a.m. the next day. And then it closes. The CME board trades, and then they reopen 3:30 again, and you have between 3:30 and 9 a.m. the next day. So very much counter to regular business hours. I'm not going to go through each of these steps, but these is kind of how you would go through using LRP for price risk protection. First, you'd want to find a local insurance agent that's authorized by RMA. So if you go to the RMA website, they'll actually give you a locator based off of where you are, offices of different agents that will issue and sell LRP. You need to fill out an application to be approved through RMA. So this application doesn't mean you actually purchased anything. It's not binding. It just means that you will be approved for LRP. Once that is accepted, you could choose to purchase a specific coverage endorsement, so a policy. And basically what SCE is, that's what's used to initiate coverage for a group of cattle. And a new SCC must be purchased for each time a producer wants to have coverage for a group of cattle. So if you're covering with an SCC policy 50 head today, you'd have to use a new one if you wanted to cover another group of 50 head, for example. Step 5, at the end of the insurance period, if the actual ending value, so when you purchase LRP, it's based off of what USDA predicts the feeder cattle index to be by the time the endorsement expires. If the actual value of that index is below what your coverage level is, then you get an indemnity payment. If it's determined that an indemnity payment is required, they'll issue a probable loss. You have within 60 days to submit that to actually get an indemnity payment. Josh, I think you said you'd put some of these links in the chat. So this is for finding a local agent. This next one is to look up daily rates and coverage levels. And then this is just the overall RMA website. So let's do a specific example. So let's suppose today we're thinking about selling 70 feeder steers that are weighing 700 pounds, and we're going to sell them in August. So that would mean you'd multiply 70 head times 700 pounds each. We're insuring coverage for 49,000 total pounds, or divided by 100 is 490 hundredweights. So if you were looking up rates and coverage levels for this scenario, what you'd look for on the website is it'd be called feeder steers weight group 2, because they're between 600 pounds and 900 pounds. And if we were planning on selling them in August, you'd select an endorsement length of 26 weeks. So luckily, based off when you plan to sell them, they'll tell you what the ending dates for different endorsements are. So you don't have to do the math of today, how many weeks out is that from when I plan to sell in August, for example. And so basically what you have to do is you have to choose the end date, so the length of that endorsement, and you have to choose the coverage price or the coverage level. So if you were going to go to this link that I've provided above, it would take you to this is publicly available daily livestock reports that would give you quotes on rates, coverage levels, premiums, etc. And you'd select the effective date. So as I said, one disadvantage of this is that it runs counter to when the board is open. So when I was actually putting these slides together on Sunday, I had to use Friday as an example. If I wanted to use today as an example for these slides, I would have had to have waited till 3:30 to put this example together. So again, if you go to this link, you'd select Tennessee as the state. We're looking for LRP for feeder cattle that are weighing that are 700 pounds, so between 600 and 900 pounds. So you'd choose steers weight 2. And it would generate this large table that gives you the expected end value, what your coverage level is, what your rates are, and what the cost is. So it generates this huge table, and it would give you the expected end date. So I had to cut this off to fit on the slide, but the next column on the right would be the end date of the endorsement. So if we were planning to sell these cattle in August, the expected end date would be in August, and you'd use a 26th week endorsement. And once you figured out the endorsement length you want, you can pick the coverage level based off of the expected end value. So this is what USDA would expect the CME feeder cattle index to be in August. That's what they're expecting or predicting today. So if this is what we expect the CME feeder cattle index to be in August, how much coverage do we want to select? So in this example, we could select a coverage level of 98.7%, which would mean that if the realized value of the index is below this coverage price, we would get an indemnity payment. So it gives you the different coverage prices. You would select your coverage level based off of really, I talked about that break-even price using your cost and how that changes with production practices, as Josh mentioned. So that's one of these considerations that you need to have in your mind as you're selecting a coverage level. And again, as I mentioned too, these coverages, they're going to be cheaper if you select a lower level of coverage. But for this example, let's say that the expected end value is $153.86 in August, and we are going to select a coverage of 94.87, which would mean that our coverage price is $145.97. So if the actual realized ending value of that index falls below this coverage price, we would get an indemnity payment. The cost of this policy is $4.21 per hundredweight. And recall that this is subsidized at 40%. So if you went to that table that gives those premium subsidies that are different based off your coverage level, this cost is subsidized 40%. So you would pay 60% of this cost would be the producer cost. So scenario one, while you're doing this, you can determine, what would your expected indemnity be under different scenarios, and you're going to know what your cost is regardless of what happens. So the first thing that we could do is, so let's assume that we picked the coverage level of 0.9487 with our coverage price being $145.97. So that's our coverage level. Based off of that, we could calculate the total amount that we're insuring. So that's our coverage price. Recall that we're planning on selling 70 head of feeder steers that weigh 700 pounds. So that's a total of 49,000 pounds, or divided by 100 is 490 hundredweights. So multiply that by your per hundredweight coverage price, and the total dollar amount that we're insuring is $7,125,525,000. We could calculate what the cost of this policy would be. So take the total amount that you're insuring. So again, your coverage price times the number of hundredweights. Take that value and multiply it by 1 minus your subsidy. So that's the subsidy, and that's going to again depend on your coverage level. So in this example, the subsidy is 40%. So we're paying 60% of that estimated cost. Multiply that by your rate, and that's going to tell you what your producer premium is, what you would have to pay, which again is no longer due at the beginning of the endorsement. And that's going to equal $1,236.86. So that's the total cost of this specific LRP policy. Again, what's nice is we know this today, and it's not going to fluctuate. So that's what our cost is. We can also go through some different what if scenarios of what happens to our indemnity, what happens to prices if the CME index changes relative to that expected value. So this top row, that's going to be what the actual ending value of the CME index is in August. Again, I just made up these 4 different scenarios. So scenario 1 means that in August, let's say that the ending value of that CME index is $135 per hundredweight. This would be if the index finished at $140 per hundredweight. And so we're in Tennessee, And like I said, that index is going to move, but local cash prices are also going to move. So let's assume that in Tennessee, we've got a $10 basis. So realized local cash prices, let's say for each scenario, they range from $125 per hundredweight all the way to $140 per hundredweight. Our coverage price, again, is based off the coverage level that we selected, again, based off of what the expected in value of that index is the same in each scenario. It's $145.97. So in this first scenario in this left column, the actual ending value is below our coverage price, right? So it fell below what we're insuring. So we would get an indemnity, which is the difference between our coverage price and the actual ending value, which in this case is going to be $10.97 per hundredweight. Our subsidized cost is $2.52 per hundredweight. So our realized price is going to be the cash price that we receive for those cattle plus our indemnity minus the cost of that policy. And again, in each of these scenarios, I'm just varying what the actual ending value is. And then given a $10 basis, that's going to determine what our cash price is. So scenario 2, let's say that the actual ending value for the CME index was $140 per hundredweight. Again, our coverage level is above what the actual ending value was. So again, we get an indemnity of $5.97 per hundredweight. The cost is the same regardless of what happens to the ending value, which is nice. And our realized price is going to be that $130 plus our indemnity minus that cost. So this is the scenario that we're protecting against. We're protecting against these scenarios of extreme price declines. Over here on the right, if the actual ending value is $150 per hundredweight, that's more than what our coverage price is. So we don't receive an indemnity, but we still have to pay that cost of that LRP policy. This scenario where the ending value is $145 per hundredweight is a scenario where prices decline, but only slightly, such that our indemnity is actually less than the cost of that policy. So Josh was using that car accident, car insurance example. So a colleague explained this to me in a way that I really like. So if prices decline just slightly, so we get a pretty small indemnity, this would be the example if you get into a small fender bender in a Walmart parking lot and your deductible is actually more than the damage of the accident. So in each of these scenarios, yes, because we purchased this policy, in this scenario we don't get an indemnity, our realized price is less than our cash price, but that's a much better alternative than if we were to not purchase LRP and cash prices decline to $125 per hundredweight, right? So this just kind of highlights what would happen under this policy scenario based off of what the CME index would do at the end of the endorsement. So there's a few considerations here. LRP, it's designed to protect against downside price risks, very much low probability extreme events. It's not meant to increase profits. And you can think of these premiums as a production cost that you could work into your overall business model. It's the cost of protecting against price risk. And then you do not have to insure 70 head, right? So the minimum is 1 head. So 70 head is a very large example. You could insure 20 head in this example. So much more flexibility in what we're actually insuring. And then to conclude here, Josh and I will come back on together to do some discussion and Q&A. But we discussed futures options and LRP. These are 3 alternatives that need to fit into your larger marketing plan, right? So you don't have to use one of these every single year, right? You can consider these as a part of your overall toolbox to manage risk. Do what you know, right? Don't do something if you're not comfortable with it, or it makes you kind of feel uneasy, right? So I'd encourage everyone, if you're interested in these different things, to invest some time to really dive into the nuts and bolts of how these actually work. So that's what I've got. I appreciate everyone listening to Josh and I. I think we'll both kind of hop on and do some discussion and some Q&A with everybody.
Yeah, thanks, James and Josh. Really appreciate you going through those and giving those good examples too in the scenarios. Those are extremely helpful. Here, before we get into Q&A, I'll mention to everybody that we're right up on the scheduled time. So if you need to drop off the webinar before we get done with Q&A, just remember, please, to follow up with the survey link that you'll get emailed to you to tomorrow at about the same time this would have started. And then if you stay on through the Q&A, though, you'll be able to click. Courtney, I think I'm saying this right. You can correct me if it's not correct, but you should be able to click after I end the meeting. Should be able to click and go ahead and do that survey and have it out of the way, and not need to wait for tomorrow. So Josh and James, the first question I'll ask you that I like to try to ask every economist now is, what in the world is GameStop and how? No, I'm just kidding. that's a joke. That'd take way too long to get into on this one, and I still don't understand it. But maybe the first thing that I'll ask you is, and Josh, I think you mentioned this to me when we were talking on the phone the other day. Looking at LRP and the changes that have been made to it, it looks like a more usable tool. James, you talked about them as tools, and we like to think of it that way. So if you were just kind of an average or maybe even a fairly large cow-calf operator, does it seem pretty logical now that the first place you'd look is LRP over the futures market?
So I'll take the first stab at it. James showed the comparison to previous subsidy levels. If you look back, not even 2 years ago, Justin, those subsidy levels were at 13%. So we've seen, subsidies double, triple, quadruple, depending on what some of the coverage levels are. So yes, I mean, I think everybody, even if you've looked at LRP a couple of years ago, take a look at it again. And I know Tennessee, I think Andrew Griffith has an LRP publication out there. Y'all got some great resources available. So yeah, I'm encouraging folks that I'm talking to right now to at least consider it. I'm not saying you got to do it. It may not make sense for your operation if you don't want to, but given the changes over the past 18 months, it's worth a look.
So
yeah, just adding that it has just become more affordable, but to Josh's last point, it's very much a individual specific question that you need to evaluate with all of those involved in your business.
Yeah. So if I did decide that I wanted to try to make use of LRP, who do I call? That's kind of one of the steps that sometimes, I talk to folks that just, where do I contact somebody about trying to use LRP?
So James, I mean, I'll take a stab at it. So it's basically the same process as crop insurance. So you need a crop insurance agent. I put a link in the chat there, Justin. RMA's website has an agent locator tool, so you can go in there and put where you are, and it'll pop everybody who can sell LRP. So you can go there to find an agent near you.
Right. Kind of looking through some of the other questions over here. So back on James, I think this came in when you're talking about the example and kind of going through some of those scenarios. Could you kind of just give another explanation of ending value and realized value? Maybe even if you need to pop those slides back up real quick, or just talking about kind of how to think about that. Value.
Reshare these real quick, and maybe I can. Let's see. We'll go to that big table that I had pulled up. We can talk through it. So basically what this ending value is. So the first slide I talked about, this is based off of what that CME feeder cattle index is. And so that's derived. It's an average of what feeder cattle prices actually are in these 12 different states. And they combine to create this index. And so futures and options, what the futures that Josh was talking about, those are cash settled for feeder cattle. So it's settled against this index. And so when we're looking at LRP, basically, if that reflects an index of feeder cattle prices, USDA, we're going to predict, what that value is going to be at the end of what our LRP, endorsement length would be. So, we picked 26 weeks here. So if we're going to sell our cattle in August and we've got a 26-week endorsement, because that's what most closely reflects when we're going to sell those animals. It gives us what our ending value is. It says that it's $153.87 per hundredweight. That's what USDA is predicting that index of feeder cattle prices to be in August, right? And so that prediction is very much going to follow, what futures prices are doing. So you can go to CME, look up the closing price for the August contract, and generally these predictions are going to follow what futures are doing. But it's the same concept as futures, right? It's just an expectation or prediction of what prices in the future are going to be, and we're basically insuring against how that index is going to change in the future. So if we're selecting 100% coverage, let's say, our break-even cost of production is $153 per hundredweight. If that's our cost of production, we might not be able to afford, prices dipping below that expected ending value at all. So we would select 100% coverage level. And, at the end of that 26 weeks, if on that day, or when that contract, that LRP contract ends, if on that day, the index is below, where it was when we purchased the contract with our 100% coverage level, then it would protect us from that and give us out an indemnity payment. I think that's just more detailed explanation of it. Josh, I'm not sure if anything else there you could add.
Go two more slides, James. So go to your last table, like on your second to last. There you go. I think maybe they were kind of asking what's the difference between that in this table, actual ending value versus your realized price there that you have.
Yeah. I just answered the wrong question completely.
No, that's good.
Should have stopped me earlier. So that actual,
okay, I wanted to keep listening because I wanted to hear that too. So you're all good.
Man. So the actual ending value is, where I just left off with. That's what the ending value of that index is, right? But that index isn't what we're actually going to sell our cattle for, right? The LRP is based off that index, but we're actually going to sell our cattle on a cash market, like in an auction. So that cash price is, let's just assume, cash price is based off of a $10 basis. So a $10 difference between, what that actual index is and what local cash prices in Tennessee are. Let's say for this scenario, we're selling our cattle in August for $125 a hundredweight. That's the realized price that we sold those cattle for at auction. The realized price is just going to be, what your net of that LRP is, right? So it's what you sold those cattle for plus what the indemnity payment was, because the actual ending value fell below our coverage level, minus what our subsidy cost is. So if you take this $125 per hundredweight, you add $10.97, and then you subtract what your premium is, you're going to get what your realized price is total for those cattle that you sold in August. But it's all based off of, what ended up happening to that index, at the end of that LRP endorsement period.
Yeah. Good. Yeah, that actually helped me going back through that second time that way. That's good. I appreciate that. And we're kind of, getting over on time here. One question that came in was asking about where we can learn more about this. In Tennessee, my answer would be, we have the farm managed specialists regionally based across the state. Of course, it's always starting with your county agent here in Tennessee, your front door of the University of Tennessee in every county. Start with the county agent, and they may connect you with the farm managed specialist in your region, or with Andrew as our state specialist. James, Josh, do you have any other, and you put some good links in here. I hope everybody will kind of ease over to the chat and click those links, open them, save those tabs. Can you think of some other resources that if I'm a complete novice and I want to, maybe there's an online course or some good publications, things like that may stick out to you?
I guess step one, when I was myself reviewing for all this, the first place I went was just, USDA, rma.usda.gov. So you go to the main RMA website, they're going to have, just fact sheet after fact sheet, just all these great kind of publications that summarize, what's the most up to date, part of the LRP. So that's a great place to start. I mean, it's right from the agency. So I'd go there too.
Yeah.
Yep. No, that's a good one. And then, I mean, y'all have got some great extension publications, Justin. Tennessee and Andrew has some publications on futures markets on LRP. So I'd certainly point folks there. And
Yeah.
and if not, call Charlie Martinez, right?
That's exactly right. And maybe I should have put his cell phone number in the chat for everybody to have. That's a good idea. Yeah. Or you can enroll at Mississippi State, University of Arkansas, University of Tennessee, and get an undergraduate degree in agriculture and resource economics, right? Yeah. Well, I guess we're going to go ahead and kind of close her down there, guys. But I want to say thanks very much, Dr. Maples, Dr. Mitchell, for being willing to come on here and go through something that a lot of us don't have a lot of experience with, and for the way you explained it for us to be able to understand. I really sincerely appreciate you taking the time to be with Tennessee cattle producers and do such a good job educating us tonight. So thank you very much.
Thanks, Justin. Appreciate everybody.
Thanks.
Courtney, do we have anything else we need to talk about before we close the meeting?
No, I think we're good. The survey link should pop up as soon as I hit end, but if not, you'll get it tomorrow night, the same time that this email started. So 5:30 Central.
Okay.
But other than that, we'll see you next Monday.
All right.
For
Sounds good.
genomics.
Yeah. Thanks, guys. See you.